Let's bring in Keith Lerner of Truist Wealth and Sandra Cho of Pointwealth Capital Management into the conversation. Keith, love your take here on where the market has brought us at this point. You know, the 6,000 level, it's above most strategist targets for the end of the year, well above the median, I think. Where do you think we should expect to go from here?
Yeah, well, hey, Mike, great to be with you and Cameron and crew. It's been a strong market, and we've been trying to keep things, pretty simple in our work, right? I mean, you've talked about it, sticking with the primary trend, which is still positive. We do have the Fed still on our side. Even if they skip a meeting, they're more likely to ease than raise at this point. We have global central banks easing, and we tend to look more at forward earning estimates or the blended estimates. Those are still moving higher, albeit at a slower pace than they have before. Valuations, which the discussion has discussed, is high, as Cameron's mentioned. It's tough to make a short-term trade on valuations. I think that tells us more about the long-term returns are likely to be somewhat lower. We also know that credit spreads today are at the lowest level in decades, so that's also showing some confidence as a whole. And then finally, seasonality, when we are up big through October, more than 15% for the S&P 500, the final 2 months have been up 19 out of 20 times. So I think that's all positive, Mike. Like you said, like when everything seems like it's all working well, it's like what's going to hit us? I mean, there's probably something from left field. Sentiment's getting maybe a little bit stretched, maybe some choppiness after this round number. But all in all, we still think that you want to stick with that primary uptrend.
Fair enough. And Sandra, as you talk to clients here after the election, you had this focal point of anxiety and expectation around it. Now we have resolution. The market has relaxed a lot. We're up 25% in the S&P 500 year to date. What would you be telling them in terms of whether, the world has changed in a favorable way, or it's more the same, or should we expect some give back?
Yes, I mean, this is post-election, and we knew that half the population was not going to be happy with the outcome. And so I am dealing with clients that, are unhappy. But what I focus on is that the elections are over and the market's like certainty. And I agree with Cameron as far as, there is momentum, and Keith, that there is momentum in the markets right now. A few weeks ago, I called the S&P 500 at 6,000 by year end, and, we hit it today. So now we're looking, our base case is 6,120 for year end. We do think that, the market is going to continue this trend and it's going to be strong. We look at consumer sentiment, it's up. And, we do think that the year is going to end, well.
Yeah, that would be another just couple percent from here, 6120. Cameron, I guess the question, too, is whether the character of this bull market has changed at all. Mm-hmm. There is this sort of pretty clear message on Wednesday's market action where it was like, OK, let's just execute the textbook Trump trade, which is small caps and financials and cyclicals, value to some degree. And then actually a lot of stocks were down, like defensive stuff and yield sensitive. To what degree are we making any kind of a sharp pivot, or is it, again, not necessarily that much of a shift?
It seems like we played that 2016 playbook for one day versus what happened in 2016 is that lasted about 2 months, and then it started to give it back up. So one of the things we're watching really closely is growth versus value. Very simple ratio, but you continue to see growth still outperform even post-election, which just suggests that maybe some of that leadership in the Mag 7 that everybody is expecting to start to fade, at least for now, is hanging in there, and maybe that is because of Tesla's strength. So clearly there is a difference today versus what we had in 2016, and so it's a question of, do we see a continuation of things like the small cap trade, even though you are seeing small cap earnings continue to get cut, valuations aren't that cheap. So clearly there's a lot of questions as to how far we can extend the Trump trades. Yeah,
Keith, weigh in on that, just in terms of whether it's time to step away from the sort of growth quality leadership we've seen in this market for a while, the market cap weighted S&P, and decide to get either more cyclical or look for laggards.
Yeah, it's interesting in our work. Our overweights right now are from 3 different aspects. We have technology, which we've been, overweight most of this year. We think the AI story is intact and earnings are intact. We're overweight financials even before this. We think if the economy stays resilient, credit's tight, M&A picks up, that's all good for the financials. Technicals are good. And then we're also overweight utilities, which, historically have been defensive, obviously a little bit of a derivative play on AI. Yesterday, I didn't feel great about utilities. Today, I feel better. So it's almost as if it's not just tech. I mean, this week too, you have financials, industrials, energy all up over 5%. So I just don't think it's an all or none. I think there's opportunities within. And again, we're playing it from those three sectors specifically and still tilted to the U.S. I will say globally, Mike, I mean, it is a big week of U.S. outperformance. We've been Team USA for some time. And, that's something that happened during the Trump trade of 2016, and we think continues into the end of the year.
Yeah, I mean, it does get tricky at some point if the argument is value is going to take over from growth and the U.S. is still going to outperform the rest of the world. But, stranger things have happened. But it seems like those things push against one another a little bit. No, Keith?
Yeah, and that's why we're pretty much neutral on value and growth. Yeah. And I will say, I think it's good for us to be thinking about what can go wrong. I mean, Cameron alluded to this, like in 2016, that was arguably a bigger surprise. Yields were sub 2% as opposed to above 4%. The deficit's a lot bigger. And so far, the market is really focused on all the positive aspects, lower taxes, deregulation, and really kind of putting off what happens with tariffs? And arguably, the policy outcomes is wider. So at some point, I think there will be a counterbalance for that market and sentiment, but maybe that's going to be a little bit delayed. Maybe it's later this year, or really more likely in the first quarter that we have to deal with some of that policy uncertainty.
Yeah, I mean, what stand as basically reflationary policies into an economy that's been kind of barreling ahead for a while, and we've tried to get inflation under control is sort of a funny mix. Sandra, I wonder what your thoughts are about the bond market here. It's been, I guess, commonly said that it seems like Treasury yields could be the arbiter of whether this policy mix has runway, whether equities can hold their valuation. We got a little bit of a scare from among some people that the 10-year yield was going to get maybe unanchored here. It's not yet done that. After the Fed cut by 25 basis points, we've kind of calmed down. How do you think about bonds as an investor at these levels?
I think bonds right now for year end, I think they're going to be, steady as far as that goes, because the only thing that, we see is that yields are pretty good right now. And we think that that's going to, finish the year. But for 2025, the concern is, as you mentioned, that if inflation starts to tick up, the Fed might pause, and then that might, kind of upend things just a little bit. So we're really keeping a close eye on that, especially if tariffs are implemented in the way that the Trump administration has mentioned. If they're imposing like a 60% tariff on Chinese goods, that really could throw things around. But we really think that that's just posturing in order to come to the negotiating table and implement better trade agreements. So, that shouldn't manifest because it would hurt U.S. companies. And I do think that the administration knows that.
Yeah, well, we'll see. I mean, that also mimics 2016-17, actually, right? Where the market quickly seized upon the positive aspects of policy, and then 2017 was full of, trade war headlines that would hit the market at least short term.
And maybe we get the reverse this time because we don't get the negotiations around taxes until the end of 2025. So the prospect of actually lowering that corporate tax is something that we would get towards into 25, into 26. But we could get tariffs right away and have to contemplate what that means for things like the dollar, what that means for cyclical companies. So maybe instead of getting the good news first, like we got last time in 2016, we get the bad news first.
That could be, although I've often thought that the best kind of tax cut is one that's on the way. I mean, because if you think about it, it was a year before the law was passed, and the market was willing to just pay for the prospect of it over and over again. I guess the other piece of it tactically, and Keith, I'll ask you this. You mentioned seasonal effects. You mentioned this tendency of strong years to finish very strong, and this compulsion of people to make sure that they're participating toward the end of a year. Is positioning right now among investors, is exposure to the market, do you feel it's low? Is it middle? Is there still room for it to expand safely?
I think probably middle high. I think, if we remember right before the election, we saw the put-to-call ratio spike. The VIX was above average. So very quickly, we've seen, that fear go out the window, and we saw the VIX plummet, as you mentioned earlier, put-to-call ratios kind of plummet as well. So I don't think, the one thing I always have to write down in November, December of doing this is like seasonality and sentiment tends to be trumped by the trend, no pun intended. So I do think that's probably something more weary for the first quarter, but I do think we have a bit more to expand before year end. I don't think sentiment is extreme at this point because there was so much nervousness and anxiety heading into the election.
Yeah, I do guess that's the question, Cameron, is kind of just how much has already been, burned off. And does it matter? Because, you hear people say, well, there's no reason to sell at the end of a year. And so therefore, the market can kind of just continue to ratchet higher.
And the question is, does that create a pull forward potentially of returns from 25 into the end of 24? Because we do know that if you're sitting on big gains because you've had a strong year, why would you recognize those gains and trim positions today versus waiting a couple of months and delaying tax payments for 16 months? So we do think that it's likely that we do get a chase into year end, but then that creates a scenario for 2025 where you have even higher valuations, even more stretch positioning, which is why our base case for 2025 is more high single digits to mid single digits types of returns, very different than the 20% plus that we've gotten this year.
Sure. Although maybe on top of, I guess it's like 37% over the last 12 months, many people would take that. We'll see. Cameron, good to see you. Keith and Sandra, thank you very much.